All right, good evening, everyone. Welcome back to the OneClass channel. My name is Osehi, and I am one of your senior economics tutors. Today, we're going to look at a couple of questions that were asked, and our junior tutors answered them. And I'm just going to walk you through their thought process and how they arrived at those answers. A little bit of background about myself is I actually have a bachelor's degree in economics, and I currently just work for one of the big five banks in Canada. So, with that being said, let's get started. But first, just a reminder, if you need any help with some of your economics homework, if you have any economics questions, anything economics related, please visit the link in the description below, and someone should be able to help you. And yeah, let's get started. And start stream. All right, question number 1. A negative externality occurs when A person's action harm others and that person does not bear the cost that the others bear. B, a person breaches a social contract. C, a person's action creates a benefit that others benefit from but do not pay for. And D, a person seizes activities that are external to the economic processes in which that person engages. Let's see what our tutor here said. He said A is correct. A person's actions harm others and the person does not bear the cost that others bear because the person cannot able to pay the cost that the others can pay. Let's see the other options now. B, a person breaches a social contract. This is false because the person tends to break the law only. C, a person's action creates benefits that other people benefit from but do not pay for. False because this is a positive externality. And D, a person seizes activities that are external to the economic processes in which the person engages. And this is false because that person externally engages in the economical process. So the correct answer is A. And that's because negative externality is an action that others incur. And it does harm others and doesn't harm the people that are producing the good or service. So it's when people produce a good or service that has a negative effect on people who are not involved in the producing process or outsiders not involved in the good or in buying or selling the good or service. So the two options here that we would be looking at were A and C, because those are the ones that are defining what an externality is. And the key word for a negative externality is that it incurs harm to others, which is why it's negative. And if it were a positive externality, it would create a benefit for others. But because it's creating a harm for others, it meets our definition for a negative externality. So the correct answer is A. And now question number 2. Explain the main difference between demand pull inflation and cost pull inflation. Analyze the differences between cost push inflation and built-in inflation. And then, does the official unemployment rate understate the true degree of unemployment in the United States? And assuming you owe $5,000 to Capital Bank, would you gain or lose from an unanticipated decrease in inflation? So to answer the first, demand pull inflation is caused by excess demand. When people get more money, they can pay more for goods and services. What economists call too much money chasing too few goods. This causes a shortage and prices rise, and usually happens in an expanding economy. So that's a perfect definition of demand pull inflation. Inflation. So this occurs when there's excess demand and it's what economists call too much money chasing too few goods. And basically when this happens, then prices need to rise so that it takes away the excess demand and the economy is back in equilibrium. And then cost push inflation, on the other hand, is caused by a disruption in supply, and these disruptions causes an increase in the cost of production. It simply means that prices have been pushed up by the increase in the cost of any four factors of production. And that again is a great definition. Basically, when there's an increase in cost of production, it leads to an increase in prices, which is inflation. So that answers the first part of this question. Let's look at the second part now. Analyze the differences between cost push inflation and built-in inflation. So we know what cost push inflation is already. We know that it's inflation that's caused by an increase in cost of production. When there's an increase in cost of production, then prices need to rise to meet those increases in cost of production. So built-in inflation is a result of adaptive expectations. Say if a worker expects there to be inflation, they would negotiate for wages increasing at or above the rate of inflation. The employers in turn pass the higher labor cost on the consumers through higher prices. Cost push inflation is an increase in price because the higher cost of production, the prices are forced to push up due to higher costs. So, again, great definition. Say, built-in inflation. So is when workers expect there to be an inflation and they negotiate for higher wages, and if they negotiate for higher wages, their employers, who are also the producers in this case, they have to get that money from somewhere to pay their employees higher wages, and that usually comes from increasing prices and charging consumers more. So that answers the second part of the question. Third part, does the official unemployment rate understate the true degree of unemployment in the United States? Let's see what our tutor said here. The actual unemployment rate likely fluctuates more throughout the business cycle than officially reported, which is a given. The unemployment rate rises during a contraction. It is higher than the official report, and as the unemployment rate declines during an expansion, it is probably lower than the official data. So that basically just tells us that the unemployment rate is sometimes overstated and it is sometimes understated. So when there's a contraction, the unemployment rate is probably understated, and when there's an expansion, the unemployment rate is probably overstated. And finally, assuming that you owe 5,000 to the capital bank, would you gain or lose from an unanticipated decrease in inflation? Our tutor says here, it's a loss to me because the value of liability in real terms rises, that there's an increase in the burden of debt. So basically what we get from that is when there is an unexpected decrease in inflation, borrowers are worse off, and that's because the money you borrowed is valued higher than what it is today, and you're basically paying more than you would normally be paying back. And lenders are better off. And this would be the exact opposite. If there was an unexpected increase in inflation, borrowers would be better off because the amount they're paying is actually valued less than what they initially borrowed, and lenders would be worse off because what they initially borrowed is valued higher than what they will be receiving, what they would be receiving. So all in all, this is correct. Question number 3. Explain the difference between explicit and implicit cost. Give an example of each. An implicit cost is the cost occurred but is not initially shown or reported as a separate cost. On the other hand, an explicit cost is one that has occurred and is reported as a separate cost. Below are some examples to illustrate the difference between implicit and explicit costs. So first off, we'll just say implicit cost is the same thing as opportunity cost, or you could call it economic cost. And this is just the cost of the value of what you could have, the other economic activity you could have been doing, rather than the current economic activity you could be doing. So basically the cost you forego to participate in an economic activity. And that's not only the monetary value, but also the benefit that you gain from whatever the alternative could have been. And explicit costs are just your regular costs, so fixed cost, variable cost, all of that. Regular costs that are just reported on a statement, like he said here, and they can also be called accounting costs. Now let's see the example here. Let's assume the company gives a promissory note for $10,000 to someone in exchange for a unique used machine for which the fair value is not known. The note will come due in 3 years and it does not specify any interest. Due to the company's weak financial position, it will have to pay high interest rate if it were to borrow money. In this example, there is no explicit interest cost. However, due to the issuer's financial duty and the seller having to wait 3 years to collect the money, there are some interest costs. In other words, there is some interest and it is implicit. I don't think I agree with that. Let's keep reading. To properly record the note and the machine, the accountant must determine the amount of interest, which is known as input into interest. In effect, the accountant must convert the implicit interest to explicit interest. This is done by discounting the $10,000 by using the interest rate that the issuer of the note would have to pay to another lender. And the rate is 12% per year. The interest that was implicit in the note is $2,880, and the principal portion of the note is $7,120. If another company with some financial condition purchased the unique machine by issuing a $7,120 note with a stated interest of the 12% year, the interest cost of $2,880 would be explicit. In this situation, there is no need to impute the interest. Another example of implicit cost is the opportunity cost of the sole proprietor working in their own business. For example, Gina works as a sole proprietor and her business reported a net income of $30,000 for the year. Since the sole proprietor does not receive a salary or wages, there is no explicit cost reported for Gina's work in her business. However, if Gina is foregoing the salary of $40,000 from another company, that is an implicit cost for her business. After considering this implicit cost, Gina is losing $10,000 by working in her proprietorship. If Gina operates her business as a corporation, Gina will be an employee of the corporation. If her annual salary is $40,000, the corporation's income statement would report the $40,000 salary in there as an explicit cost for Gina. Okay, so it seems like this person has somewhat of an understanding of implicit and explicit cost. I'm gonna say we'll just make this simple and use his second example here with the example of the implicit cost. If Gina were to, and another implicit cost is the opportunity cost of a sole proprietorship for working in her own business. So if Gina was working in her own business, her implicit cost would be whatever she could have done instead of working for her own business. So if she worked for a corporation, that $40,000 would be reported as an implicit cost. So basically, the implicit cost is just the opportunity cost. And explicit cost, well, there's different costs that she could have used to start up her operation, or even just get something as simple as a desk and an office chair in her office. That is a cost for her business, and those are actually explicit costs because it has to do with her current business and what she's doing. The implicit cost, like our tutor here said, it would be if the salary of another job was $40,000, her implicit cost could be that salary of $40,000 that she's missing out on to work as a sole proprietor. So let's say for the most part, this is correct. But some of the explanation is wrong. All right, question number 4. What does income elasticity of demand measure? Here says income elasticity of demand measures the relationship between a change in quantity demanded for a good and a change in real income. So let's put that down. So it's basically percent change in quantity demanded over percent change in income. Inferior goods are related to negative income elasticity of demand. So if this is equal to a negative number, meaning if quantity demand does not change that much with an increase, then it is an inferior good. And while normal goods are associated with a positive income elasticity of demand. So that is the correct definition of income elasticity of demand. Now let's see the second part of the question. If income elasticity of demand for ibuprofen was 0.63, then you could say that ibuprofen's income elasticity of demand is 0.63, which is less than 1. Goods with income elasticity less than 1 are called normal goods. Hence, ibuprofen is a normal good. Its demand increases as people's income increases. Yeah, this is correct. And if demand were to decrease as income, this is supposed to be an I. If demand were to decrease as income increased, then it would be an inferior good. So because it's positive, it is a normal good. However, if the change in demand was negative as income increased, then it would be considered an inferior good. So this is correct. And question number 5. Show your work. The following table shows the demand for dump trucks that your company sells to a relatively stable and predictable gravel mining industry in your state. A, calculate the midpoint price elasticity of demand between 80,000 and 100,000. Is the demand in this range elastic or inelastic? So we know elasticity of demand equals percent change in quantity demanded, or percent change in quantity over percent change in price. So if we look at part A, P1 equals 80,000, Q1 equals 100, P2 equals 100,000, Q2 equals 95. So elasticity of demand is equal to P1 plus P2 over Q1 plus Q2 multiplied by Q1 minus Q1 over P1 minus P1. and that's 180,000 over 195 multiplied by minus 5 over 20,000, which gives us minus 45 over 195, which gives us negative 0.23. So our demand would be inelastic here because it is less than 1. So yeah, quantity demanded is still increasing, but it's increasing at a very low rate. So since it's less than 1 in elastic demand, let's just go over what elastic, inelastic, and inelastic demand is. So demand is elastic when E is greater than 1. It is unit elastic when E equals to 1, and it is inelastic when E is less than 1. Now we know as price increases, demand is obviously going to decrease, so that's why there's a negative sign. But this number right here, because it's less than 1, it qualifies as inelastic demand. Part B says calculate the midpoint price elasticity of demand between 100 and 120,000. Is demand in this range elastic or inelastic? Let's look at that as well. So we have P1 plus P2 over Q1 plus Q2 multiplied by Q1 minus Q1 over P2 minus P1, which is 220,000. That's 100 plus 120 over 183, which is 95 plus 83. And multiplied by the difference. So this is negative 7 over the difference between the two prices. And this is 20,000, which is what is done here. And that gives us negative 0.42. So again, because it's below 1, ignoring the negative, because it's below 1, it falls as inelastic demand. And part C says, reflect on your answers regarding the elasticity. Explain in few sentences why this is a plausible result for the dump truck market and servicing the state's gravel industry. State any assumptions you use in your rationale. And our tutor here said, when elasticity of demand is greater than 1, then it is known as elastic demand, as the percentage change in quantity demanded exceeds the percentage change in price, which we show here. While elasticity of demand represents less than 1, that would be inelastic demand, which means the percentage change in quantity demanded is less than the percentage change in price. And if we're equal to 1, then that means the change is the same. So it's correct. So question number 6, analyze the relationship between inflation and money. The relationship between inflation is dependent on the supply of goods and services. If supply of money increases, there will be an increase in aggregate demand of goods and services. If this increase in demand is met by an increase in the supply of goods and services, there will be no inflation. But if demand is not met, there will be excess demand and a shortage of supply, which will lead to an increase in prices of goods and services and lead to an increase in inflation. So basically it's just saying that inflation is dependent on money supply, once money supply increases, demand should increase as well. But if that demand does not meet the increase in money supply, then there will be an excess demand, and and when there's an excess demand, as we saw in the previous question below, then there's too much money chasing too few goods. And because there's too much money chasing too few goods, then you need to increase prices to put the economy back in equilibrium. And that increase in prices would lead to inflation, because inflation literally means when prices are increasing. So this is correct. And this also ties back to demand pull inflation. All right, question number 7. Unemployment is defined as the total number of people who blank. The unemployment rate is measured as blank. What category do underemployed belong to? What category do discouraged workers belong to? What is required for a person to be considered unemployed? So unemployment is defined as the total number of people who want to work but are unable to find work. Let's be no either. So unemployment number of people looking for a job but are unable to find one. Part B, the unemployment rate is measured as the percentage of people in the labor force who are unemployed. So the unemployment rate equals number of unemployed over total labor force participants. This is calculated by dividing the unemployed people by the number of people in the labor force, which comprises all employed and unemployed people. So that being said, the labor force is a sum of the employed people and unemployed people in the population. The underemployed individuals are treated as employed, and this is because they have a job, so they not meet the requirements of unemployment. And the discouraged workers are those individuals that are not looking for a job and are not included in the unemployment category. So these are basically people who were looking for a job, they weren't able to find one, and they stopped looking. And because they stopped looking, they are not considered unemployed or employed. The discouraged worker is one who possesses eligibility for employment and has the capacity to work, but is currently not employed and has not attempted to find a job in the last 4 weeks. So basically, they are able to work, but they haven't been searching for work. And for several reasons. It might be because they were unable to find work for so long and they just stopped looking. So because they haven't been looking for a job in the last 4 weeks, they wouldn't be considered unemployed and they wouldn't be considered employed either. What is required for a person to be considered unemployed? An individual is considered unemployed if he or she is currently not employed and they're actively looking for employment within the last 4 weeks and he or she is also available for work. So we'll just erase all this. So what is an unemployed individual? Person is unemployed, so they have no job. They're actively looking for a job and they are available to work. So that answers all here, and this is correct. And this is question number 8. What is the difference between current account balance and the capital account balance? The current account balance shows the difference between exports and imports of goods and services, as well as unilateral transfers. That's correct. And the current account surplus means the country is a net exporter, and the current account deficit means the country is a net importer. So exports, imports, unilateral transfers, current account surplus means the country is a net exporter. CA deficit, net importer. And capital account records transactions relating to the sale and purchase of foreign assets during a given year. The balance of the capital account indicates changes in stock. Capital account surplus is a net sales of asset, and a capital account deficit is a net purchase of assets. So basically, a capital account keeps track of the flow of money between a nation and its foreign partners. And when there is a capital account surplus. It is a net sale of assets. And when there is a capital account deficit, it's not a net loss, but it's a net purchase of assets. So that explains current account and the capital account balance. So this is correct. I think this might be the last question today. This is question number 9. Marginal cost may be higher than average variable cost because A, marginal cost includes fixed costs while average variable cost does not. B, marginal cost represents the variable cost of producing the last unit, which can be very steep if you're pushing the production system to its limit. Average variable cost is based on all of the units produced. Or C, average variable cost only includes labor, while marginal cost includes all variable costs. And even if you didn't know what the answer to this question is, you could already eliminate 2 of them because you could eliminate 1 of them because it says average variable cost only includes labor, while marginal cost includes all variable costs, and that's not true. Average variable cost, if it's the average variable cost, it has to include all the variable costs in production, and labor might not be the only variable cost. So we already know C is wrong. Now let's look at A and B. Your tutor here says B is the correct answer. And you say marginal cost is, oh nice, they drew a little graph for us. Marginal cost is the additional unit of output, while average variable cost is the cost per unit of output produced. Marginal cost represents the cost incurred from an additional unit of input employed to produce more goods, which is also a variable cost. Marginal cost higher than average variable cost occurs after the minimum average variable cost, where marginal cost is equal to marginal cost. If the firm continues to produce under marginal cost equals average variable cost, it will incur more both marginal cost and average variable cost, where marginal cost is higher than variable cost. So basically I do agree that B is the correct answer. I do agree B is the correct answer because actually A could also be correct because fixed costs are included in marginal costs and variable costs are not included. But B is just a more complete answer because if you're really pushing production, then the change in marginal cost could be significantly higher than all the other costs. And if that change is significantly higher, it would be shown on the marginal cost, but it wouldn't necessarily been shown on the average variable cost because average variable cost includes all the variable costs as a whole. So the complete answer here would be B. But A, is a partially right answer, because marginal cost does include fixed costs, whereas average variable cost does not. And because marginal cost includes all the additional costs of bringing in a new output or a new unit, average variable cost won't reflect all the costs. It will only reflect the variable cost. So I think A and B are correct here, but the more complete answer is B. So we'll say this is correct. And that's it for today's session. Thank you for taking the time out of your day to look at some of these questions with me. I hope this was helpful, and we continue to encourage you to look in the description below and if you have any questions economics related, any homework that you might need help with, submit your questions and our tutors should be able to help you. So thank you, and enjoy the rest of your Friday evening.